There's a pattern in finance that's caused three major crises in the last century. And guess what? It's happening again in 2025. Back in the 1920s, banks ignored the stock market bubble, leading to the Great Depression. Then in the 90s, hedge funds got tangled up in complicated derivatives, almost crashing the system. Fast forward to 2007, and big players bundled risky subprime mortgages into safe securities, totally missing the housing bubble signs. Now, the American insurance industry is deep in this mess. We're not just heading for a crisis, we're already in it. This is how financial systems break, and it's happening way too fast. A silent alarm is ringing across America, not in the stock market, but in your homeowners policy. Major insurance companies are bailing on entire states, showing that climate risk is a real deal, not just talk. This isn't just a small tweak, it's a huge shift. The promise that you can rebuild what you lose is cracking, and the fallout is just starting. This quiet retreat is the first sign of a big economic shakeup hitting the places millions of us call home. California, Florida, and Louisiana are ground zero for this crisis. Big names like State Farm, Allstate, and Farmers Insurance are hitting the brakes, stopping new policies and even dropping existing ones. It's not just about higher prices, they're bailing on the market altogether. For those lucky enough to find coverage, premiums are skyrocketing, up hundreds of % in just a year. This isn't just a small retreat, it's a big statement that these states are now seen as too risky to insure. The reason for this unprecedented retreat is brutally simple. Record-breaking wildfires, biblical floods, and supercharged hurricanes are making vast regions of the country fundamentally uninsurable. The very business model of insurance, spreading risk across a large pool of customers, breaks down when the probability of a catastrophic event approaches a certainty. These companies are not environmental activists. They are cold, calculating financial institutions. Their data tells them that the fires that incinerated entire towns in California and the storms that flattened coastal communities in Florida are not anomalies. They are the new normal, and insuring against them has become a losing gamble. For decades, the insurance industry was built on a foundation of predictability. Actuarial models, the complex algorithms that predict future losses, were based on a century of stable climate patterns. But that foundation has crumbled. Those models are failing spectacularly because the past is no longer a reliable guide to the future. Disasters are not just happening more often, they are happening with a ferocity and scale that the old algorithms never accounted for. The 100-year storm is now a once-a-decade event. The historic wildfire season is now every season. The models are broken, and the industry is flying blind into a storm of unprecedented risk. The financial results have been catastrophic for the insurers themselves. In recent years, losses from climate-driven disasters have consistently and massively exceeded what their own models predicted. Payouts for claims have destroyed profitability, turning once lucrative markets into financial black holes. For an industry built on managing risk, this is an existential threat. They cannot price policies high enough to cover the escalating losses without making insurance unaffordable for everyone. Faced with this impossible choice, they are choosing the only rational option from a business perspective: to get out. Reinsurance costs are skyrocketing, and it's causing a real mess. Global reinsurers are raising prices or just flat out refusing to cover American risks. This puts primary insurers in a tough spot. Without affordable reinsurance, they can't handle the massive risks from hurricanes or wildfires. So, they're bailing on the markets that create those risks, leaving homeowners and whole states in the lurch. This exodus is often happening quietly, almost by stealth. Instead of issuing headline-grabbing mass cancellations, many insurers are using a strategy of non-renewal. They simply wait for a policy to expire and then decline to offer a new one, quietly dropping tens of thousands of customers at a time. This allows them to shrink their exposure in high-risk areas without triggering the public and regulatory backlash of a formal withdrawal. But for the homeowner who receives that non-renewal notice in the mail, the effect is the same. They are suddenly uninsured, alone, and financially exposed in a region their own insurer has declared a lost cause. In the face of this private market collapse, governments are being forced to step in. State-backed insurers of last resort, like California's FAIR Plan and Florida's Citizens Property Insurance, are swelling with new customers who have been abandoned by private companies. But these programs were never designed to be the primary insurers for millions of people. They are financial time bombs, underfunded and already stretched dangerously thin. A single major hurricane or wildfire season could easily bankrupt these state funds, pushing the ultimate cost onto taxpayers and creating a spiraling crisis of public debt. The consequences are already rippling through the real estate market. Without private insurance, securing a mortgage is becoming nearly impossible in many high-risk areas. Banks will not lend hundreds of thousands of dollars on an asset that cannot be insured against total loss. As a result, property values in these vulnerable regions are starting to fall. A hidden crash is beginning to unfold, driven not by interest rates or market sentiment, but by the availability of insurance. Insurance is rapidly becoming the new, non-negotiable gatekeeper for real estate lending and development, determining which communities will thrive and which will be left to decline. This creates a terrifying trap for millions of ordinary people. Residents and small business owners are being priced out of coverage they have relied on for their entire lives, forced to choose between paying ruinous premiums or going bare, carrying the full risk of a disaster themselves. This increases systemic vulnerability on a massive scale. When a storm hits an uninsured community, there is no money to rebuild. Families lose their life savings. Businesses close forever. The economic shockwave doesn't just affect individuals, it cripples the entire community's ability to recover, creating a permanent cycle of poverty and displacement. Climate change has jumped from the back pages to the front of business news. It's now a real economic threat for major financial institutions. What used to seem like a far-off issue is now all about dollars and cents, profit and loss. This isn't just a debate, it's a numbers game we can't ignore. And this is not just an American problem. The pattern is global. Insurers in Europe are pulling back from providing flood coverage along major rivers. In Asia and Australia, coverage for storms and bushfires is becoming harder to find and prohibitively expensive. From the coast of France to the suburbs of Sydney, the global insurance industry is sending the same clear message. Certain parts of the world are becoming too risky to underwrite. The financial retreat from climate risk is a worldwide phenomenon. In response, some innovative firms are experimenting with new products like parametric insurance, which pays out a predetermined amount automatically when a specific disaster threshold, like wind speed or rainfall level, is met. This can speed up recovery, but it is still a niche product that doesn't cover the full cost of rebuilding a home or business. It's a bandage, not a cure. The core problem remains. The actual physical risk is outpacing our financial capacity to manage it. This forces an impossible choice onto policymakers. They are now under immense pressure to either create massive government subsidies to make premiums affordable or to fund colossal infrastructure projects to enhance climate resilience, building seawalls, managing forests, and upgrading storm drains. Both options are astronomically expensive, pitting the immediate needs of homeowners against the long-term fiscal health of the state and nation. There are no easy answers, only costly ones. The insurance retreat exposes a devastating feedback loop that is just beginning to accelerate. As climate risk rises, insurance coverage disappears. Without insurance, there is no money to rebuild after a disaster, making recovery slower, harder, and often impossible. This lack of resilience, in turn, makes the area even riskier, causing even more insurers to flee and property values to plummet. It is a spiral from which there is no easy escape. A slow-motion economic collapse playing out community by community. Investors are watching this unfold with growing alarm. They understand that a stable insurance market is the foundation of the entire real estate finance system. If that foundation cracks, the $50 trillion US real estate market built on top of it begins to wobble. The collapse of the insurance market in a major state would not be a regional problem. It would be a systemic financial event with the potential to trigger a national economic crisis. What we are witnessing is the first wave of a new phenomenon: climate-driven financial migration. It's not just people moving away from flood zones, it's capital, investment, and financial security fleeing entire regions deemed uninsurable. As insurers redraw their risk maps using advanced satellite data and AI-driven climate modeling, they are effectively deciding the economic future of millions of Americans. Their algorithms, though still struggling to keep pace with reality, are creating a new geography of haves and have-nots, of the insurable and the uninsurable. When nature gets too pricey to insure, who foots the bill? Will it be the big corporations that thrived in a stable climate? Or governments, using our tax dollars to cover what the market won't? Maybe it'll be everyday homeowners left to deal with the fallout of a world they thought was safe. The insurance industry is backing off, and that's a huge financial red flag we can't ignore anymore. It's time to figure out what we're going to do about it.